Welcome back, everyone. Michael with Offshore Citizen, once again continuing my lengthy video marathon for today. I'm going to see how many videos I can record and queue up for you guys. So once again, we're here in Bulgaria, beautiful day in the backyard as we enjoy our lockdown period. So today I'm going to talk about a subject which is how to maximize your tax savings no matter who you are, okay? And this, one of the things that's going to be unique about this one is this applies whether you are doing domestic or international tax planning, whether you're a freelancer or a huge business owner or investor or anything in between, okay? This is everyone, and it comes down to what I call the 3 ways to save on tax, okay? So just remember that there's always and only 3 ways that you can save on tax, all right? So I'm going to go through all of them of 3, and then I'm going to explain a little bit about each one. And if you have any questions, you can contact us and find out some specifics about how to apply them and how to save a bunch of money. Because let's face it, saving money is a really great thing, especially when you're not giving it to a corrupt government who is misusing your money. So, number 1 is the thing that we're probably most used to thinking about is your tax rates. Okay. Now, here's the thing about tax rates. So long as you're domestic, there's not that much you can do about your tax rates, okay? Maybe you can move to like a different province or state, and lower your tax a little bit. Maybe you're in a situation where you can get investment income at a favorable rate, say dividend or capital gains or something like that, as opposed to regular earned income. But by and large, so long as you stay in your same place, your tax rate is gonna be, there's only so much you can do about it. So in order to get around that, you either need to do some sort of international structuring, right, which is the main thing that we help people with, or you need to be willing to move, possibly both, so both can be great. You can go to some other country, maybe in your country, the tax rate is 40, 50%. You can go to some place here in Bulgaria, it's 10%, and you can often get it down to 5%. So wonderful, that's good. You'd save a lot of money if you were making any sizable amount there, so great. What's next? The next thing, aside from reducing your tax rate, is you can reduce your taxable income, okay? So this typically does not mean making less money, but making less taxable money. So the most common way that we're used to seeing this is in terms of write-offs, okay? If you're not used to doing business, very simple explanation is that businesses pay tax on their after expense income, right? Whereas individuals tend to pay it on their before expense income. So, for example, let's say that I have a business. The business makes $100,000, and the business has to pay for a cell phone, and it has to pay for a computer and a vehicle and some office space, right? So those all get deducted from your $100,000. Let's just say, for instance, it brings you down to I don't know, $70,000. Then you only pay tax on the $70,000, right? So you saved the tax that you would have paid on the $30,000. Great, wonderful. By contrast, as an individual, normally you're in a situation where you make the $100,000, you pay tax, and then you spend on your cell phone, your car, your etc. what's left. So by reducing your taxable income, you can go and you can pay dramatically less income or tax. So I was just talking to a friend like a few minutes ago before I started this video, and he was commenting, he much rather, even though the tax rate in the country that he is in is lower, he would rather pay tax in the foreign country because their write-offs are better, right? So this is what we do. We aim to reduce write-offs. And so part of the equation is not just how much do you get your tax rate down, it's also how much do you maximize your write-offs, because it's the amount of tax you pay at the end of the day, not the tax rate, that is fundamentally important, okay? In some countries you have better write-offs, some countries you have worse write-offs, sometimes it's more hassle, sometimes it's less hassle, and so on and so forth. Okay, so that's number 2. Number 3 is deferral. Deferral is the most underrated form of tax planning, okay? So how does deferral work? For a long time, all US tax strategies were deferral strategies. What did that mean? International tax strategies, that is. That meant that, okay, we could get it so you'd pay 0 tax, but the money would have to stay offshore, right? And the idea was that at some point in time in the future, maybe inevitable, it might be indefinite, but at some point you're gonna bring it back, right? Now, what's it worth if you say, okay, well, hey, I don't pay the tax today, but I'm going to pay it in 30 years? Well, the reason why it's valuable is the value of deferral, meaning that you can grow that money, okay? Now, that brings up a whole bunch of anti-deferral rules, which, you can go and check out our videos on CFC rules, etc. But fundamentally, you have to pay attention to the value of deferral. And so I'm going to give you the Tony Robbins math on it, which when I heard it, I thought, this is unbelievable. I went and did it for myself, so I tested that it is actually accurate, and it is somewhat misleading because it purports a scenario under which none of us will ever exist, but you know, it at least shows the significance of the math. Okay, so here's the basic idea. Let's say you start with $1, okay? And every day, or every period, it could be a year, it could be a month, it could be whatever the period is, but each period, that amount is going to double. Okay, so 1 becomes 2, becomes 4, becomes 8, becomes 16, becomes 32, becomes 64, becomes 128, becomes 256, becomes 512, becomes 1024, becomes 2048, and so on and so forth, right? At the end of, I'm going to have, you know, my math is going to be probably a little bit off here, but I think it's after 20 periods, so 20 years, we're assuming, okay? How much would that be? Okay, how much does your dollar turn into? The answer is a little over $1 million, okay? So $1 becomes $1 million after 20 doubling periods, okay? Maybe it's 30, but anyway, pretty sure it's 20. Now let's flip that equation around. I think it's like 1,048,000 or something like that. So if you were to instead tax yourself on each of those increments, so let's say that this was each year, right? So your money's doubling each year, versus in this particular case it doubles, but you get taxed each time at a rate of 33%. Then how is that different after 20 years? So again, let's kind of give the scenario. The scenario is 1 becomes 2, but then you get taxed 33% on the gain, right? So it's actually 1.67 because you got 33%, you gained 1. So you had the 1 plus you added 1, and that 1 got taxed at 33%, so you have 67% or 67 cents left, so you have $1.67. Then you double the $1.67, you know, so that's going to give you, you know, just a little over $3.20. But then that $1.67 that you doubled is going to get taxed at 33%. It's going to be removed, and so on and so forth. So in the one scenario, you had $1,048,000 approximately at the end of your 20 years, right, or whatever your period is. What over the same period of time would you have if you paid the tax? So, you know, you could logically, somebody might say, okay, well, you're going to have $670,000, right? This might be a logical answer because $1 million approximately less 33% is going to give you, you know, that's bring you down to 670,000. No, that's not the case. So it's going to be much lower than that. So you say, okay, well, maybe, I don't know, maybe you lost out because the problem is that 33% that you're losing is compounding, right? It's working against you. So you think, okay, I don't know, maybe is it 300,000? No, it's much less. 200,000? No, it's much less. 100,000? No, it can't be lower than 100,000. Okay, it turns out it's approximately $28,000. So the difference between paying tax along the way and not paying tax is literally $1,020,000. That's a big fucking difference. Huge difference. Massive. Insane. Some weird noise going by. Anyway, big difference that you have to consider there. And so that's the impact of deferral. Now you could say, okay, well at the end, say you deferred, but you still had the 33%. In the other, you could sell out, and maybe you still pay the 33% at the end. You're comparing 670,000 approximately, a little over 670,000, to, again, 28,000. Massive difference. Massive, okay? So now, one of the things that I frequently run into is we got a lot of clients who they make a bunch of money. They've got maybe a good online business or something like that. They're making, you know, mid 6 figures to mid 7 figures, sometimes 8 figures in profit a year. And they're just having the money sit there. They've got millions of dollars sitting in the bank doing nothing. Well, if your money's just sitting there, then you don't benefit from it, right? You don't benefit from the effects of deferral. But if you can, it's a big thing. Now, the good news is you can benefit from the effects of deferral as anyone, no matter where you live, okay? So how do you do that? Well, first of all, Warren Buffett is a classic person who does this. How does he do it? Well, you only get taxed on a capital asset that's growing in value when you sell. So this is one of the reasons why, you know, people who are quote unquote, why the rich have an advantage, right? They have an advantage in the tax system because earned income is taxed at a higher rate, typically, already than capital is, right? You often have better capital gains rates, better dividend rates, which is the thing that Warren Buffett argues against, shouldn't be there. But even if you were to take that away, the capital has the effect of deferral. So for example, you buy a house. The house, you sit on it for 20 years. Over 20 years, let's say it goes up, you know, a modest, I don't know, let's say that let's say it goes up with inflation, right? 3% a year. Okay, so over that period of time, it's going to take you, I don't know, it basically probably doubled in about that time, right? At 3% a year, probably doubled approximately. So, okay, that $500,000 house is now $1 million. You made $1 million. Well, if you had made that $1 million incrementally over the course of time, it would have been worth a lot less than it's worth if you get it at the end. Never mind the fact that you get taxed at a more favorable rate at the end. Same thing with something like a 401k, a Roth IRA, a TFSA, an RRSP, or other retirement saving vehicles in various countries. So I'll hear people be like, oh, you know, 401ks are a ripoff. 401k is not an investment. It's an investment vehicle. So you don't invest in a 401k. You buy investments through the investment vehicle, which is a 401k. And the 401k, it depends on what it's invested in, whether it's good or bad, right? But the wrapper gives you an inherent tax advantage. You're far better off to be investing via that vehicle if you're investing in the same thing in both scenarios, right? So you're buying the same stocks, the same ETFs, whatever, the same mutual funds. You're far better off to do it through one of these retirement vehicles, one of these registered vehicles that gives you some sort of tax deferral, because the growth doesn't get taxed along the way. It's even better because in that case, you can trade in and out of it and you're not going to get taxed until you pull the money out. Or, I mean, it depends on the type of the vehicle, right? If it's some of them you put in after-tax dollars, and because you're putting in after-tax dollars, then you don't get taxed when you pull it out. In the other case, you get to write it off at the beginning and then you get taxed when you pull it out. So, you know, but the math works out the same, okay? Whether it's at the beginning or the end, it's the same. The whole point is there's different psychology. That's a whole other conversation. But from that standpoint, this is the case. So what does that tell you? Well, it tells you that there is an intrinsic benefit from a tax standpoint, which translates into a returns benefit in buy and hold strategies, okay? So I'm not necessarily saying you should do buy and hold from an investment standpoint. I think there's a whole bunch of reasons why that might be a bad idea. But if you can do that, you have to factor, if you're comparing an active buying and selling strategy and comparing it to a buy and hold strategy, you have to consider the buy and hold strategy has better tax treatment. It simply does. So you're keeping more. So for example, let's compare if you were doing an interest-bearing, let's say you invest in a mortgage investment corporation or some sort of a bond, etc., and let's say you're getting a 9% rate of return, okay? So because of the fact that you're getting taxed at full rates rather than, let's say, capital gains rates, and you have the effects of deferral, right? Actually, you only need to make like 5% to be equivalent in terms of the actual money you keep at the end of the day, right? Because you get, okay, you're gonna pay higher tax versus, and then on top of that, you don't get the benefits of deferral. So the compounding is not as good. This is a very interesting thing to pay attention to. Now, it is possible if you do your international structuring properly to be in a situation where you can get the benefits of deferral off something like a bond, right? Off something like a mortgage investment corporation, off, you know, some sort of interest-bearing thing. I was talking to a friend and client the other day who was asking about, you know, the ability to lend money against U.S. Real estate, or just in general. You can get what's called portfolio interest as a foreigner, and you can not pay tax. You can be free of withholding tax on that. That's very good. That's an excellent situation if you can get portfolio income and not have to pay that tax. Wonderful, you know, fantastic. It gets good if you're a foreigner investing into, let's say, the U.S. and you go and let's say you're investing in startups. Well, interestingly, you know, when you sell those shares, you don't pay U.S. capital gains. So you don't pay any tax in the U.S. Now you might pay it in your home country, but you could structure it where you don't have any tax in your home country, and then you just got away with that. Doubly good. Fantastic. Okay, so let's talk about, you know, ways that you can do this. So we talked before about you can reduce your tax rate either by changing the structure of the income. That's one thing that you can do. So for example, I'm here in Bulgaria. I did a video, we'll see when the order of videos comes out, but I was talking about tax planning for people who live in Bulgaria. So here you have a flat tax on income, which is 10%, or 5% on dividends. Well, you know, if I can earn income as dividends rather than regular income, you know, I just saved 5%. Okay, great. That's good, right? Same thing, you know, if you're in Canada, dividend rates are lower, capital gains rates are lower. If you're in a lot of the world, the US, qualified dividends and capital gains are lower. You know, a lot of the world has this. Some places you have zero capital gains tax. Some places you have zero tax on dividends. So fantastic, right? If you live in Singapore or Malaysia or something like this, perfect. You know, great benefit. So, all right, that's a big thing that you can do is just changing the structure of your income in order to pay less tax. Second thing, you can be in a situation where you can move, right? Now, moving is probably the least desirable thing for a lot of people, right? It is a big thing for most people, just psychologically, with the connections, their friends, what's established, etc., to move abroad. Okay, so whether you're going to do that or not, I think I think a lot more people should consider moving, because as you go, you start to experience the world differently, you meet different people, you broaden your horizons, you get different ideas, you have different opportunities, you can cross-pollinate those ideas. I get a lot of opportunities because I'm a very international person, because I have friends on most of the continents in the world. I don't have any on Antarctica, but people everywhere else, I know people on those continents. And because I know people on those continents, that gives me opportunities by being able to connect people and make things happen. Very good, wonderful situation. If the market is down in one place, it might be up somewhere else, right? There's lots of different benefits to this. In addition to, I think you're just a better person if you're more worldly, if you understand the situation that other people are in, if you've connected with other people. I think it breaks down racial prejudices. I think, I think there's so many values in not only traveling, but in living abroad, okay? That's my opinion. But, it's not for everybody, right? Some people are going to choose to live where they live, and that's that. Even if you don't live where even if you don't want to move, you can often set up foreign companies and you can benefit from some sort of an international structuring scenario. So that can often reduce your taxes in terms of your tax rate of the income that the company makes, and potentially have write-off and potentially deferral benefits, okay? Just depending on how it's structured. Now that's very complex. This is why people call us, and we go through, etc. If you want to book a call, you can go to clarity.fm//Michael Rosmer, or you can go to offshorecapitalist.com or offshorecitizen.net, and you can book to go and talk to me, and we can discuss that. Anyway, so the next thing is write-offs, right? So maximizing your write-offs. Now, the thing here, if you deal with pretty much any local accountant, this is what they should be helping you with. There are varying degrees of how good accountants are and how they can structure this, but let's talk about a few things. One is you could potentially have maintenance type expenses as opposed to capital purchases. Okay, so just from an accounting balance standpoint, often your write-offs are better. This is one of the reasons why businesses will lease a car as opposed to buying the car, right? Because the lease will be 100% write-off in many, many cases, depending on the country you're in, etc. And the capital purchase will be potentially written off over a few years, so you don't have as much deferral basis on there. And on top of that, often you don't get a full write-off. Okay, so just depends on your individual situation. Your accountant can help you with that, but that's something. Beyond, and sometimes there's personal opportunities for that. Sometimes you can do charitable donations. Sometimes you can end up in a situation where you can get tax credits as opposed to write-offs. The tax credits are basically, the difference would be it's like counts as tax paid, right? So when you do a write-off, it reduces your taxable income. So say your taxable income is $100,000. Now you spend $10,000. Now you have $90,000 of taxable income. Let's just say your tax rate was 50%. So you have $45,000 of tax to pay. If that $10,000 was a tax credit instead, then what ends up happening, you say you have $100,000, your tax owing is $50,000, but you have a $10,000 tax credit that you can apply to there, so you end up actually paying $40,000. And you get things such as IP boxes. So an IP box is a situation where if you're developing intellectual property, certain countries will give you credits for this, so they'll allow you to blow it up. And the rules are always changing. I think Lithuania has some of the best ones right now, where you can ramp it way, way up. And it's basically designed to encourage companies to come to the country and develop the IP there and utilize it there. And so you get these tax benefits. So these are things to pay attention to, right? It could be Lithuania's about 15% tax. All right, not horrible, but you can get a better situation through some of these incentives, okay? And by the way, sometimes you can get free trade zone things going on as well. So all kinds of different fancy things to pay attention to. Okay, this brings us to deferral. What can we do for deferral? Well, first of all, often, it depends on the country. So for example, they screwed you in Canada recently, kind of over the last few years. But often what could happen is you say, hey, look, the company is going to make the money. I'm going to pay what is a lower corporate tax rate than personal tax rate, and I'm going to leave the money in the company. Okay, so let's look at UK as an example. So UK, you're talking about like 18% tax corporately, right? But your personal tax is quite high, right? So maybe you're going to pay 40% personal tax. You don't want that, right? So you say, okay, well, what I'm going to do is I'm going to leave the money in the company, and I'm going to defer it. I'm going to do stuff with it inside the company, rather than taking it out, paying the 40% tax, then doing something. I'm going to pay, 18% tax, then I'm going to do something with it. So this whole thing is basically what ends up happening. So very, very important to pay attention to all of that stuff. What is some other things you can do? Well, you can do it with foreign companies, right? You can do it with trusts. You can do it with foundations. So a lot of the times, countries have designed what they call anti-deferral regimes. Very smart, right? Very smart, because essentially it's like taking a loan from the tax department is what they'll say. And to counteract that, they do different things. Like in the U.S., if you have certain trusts, there's something called throwback tax, which is designed to counteract this. This is where controlled foreign companies rules come in. There's anti-deferral regimes, say for trusts, when it comes to something like Australia. But if you understand how to structure it properly, there's often cases where utilizing trusts, foundations, corporations, you can end up deferring income that you wouldn't normally be able to defer, and do that fully legally. And so if you can do that, perfect. You're way ahead of the game by doing so. So those are the three ways to save on tax. I mentioned you can buy assets that are long hold. So anyone can it's one of the advantages of buying, say, a piece of real estate. In addition to, sometimes real estate has a lot of write-offs that you can associate with it, so that's good. It's one of the advantages of holding a stock very long term, or holding an index fund very long term, as well as there's these different registered vehicles that you can go. So anyway, I hope those help you. I hope that gives you like a general sense of what your options are out there. These are the three ways, and then how they apply to you particularly. Obviously, depend on your country, depend on your unique circumstances, what income you're making. And if you'd like some help with that, please reach out. We're happy to help you. Like I said, you can book a call with us, clarity.fm/Michael Rosmer. You can go to offshorecapitalist.com. I have a link there on the side that you can book a call, or offshorecitizen.net. You can also book with us there. Maybe you want to work with us in some bigger way. We can help you to not only figure out what the best solution is for you, but how to implement it and help you to implement it, help you to maintain it. And then on top of that, there's also the fact that if you want help with moving abroad, if you want help with banking, etc., we're happy to help you with any of that stuff. So I hope that was helpful. If it was, or even if it wasn't, subscribe to the channel. Apparently there's some bell thing. I'm not aware of all these YouTube intricacies, but do all the stuff that is going to keep you hearing about the next videos. We're going to try and post lots of them and try and continue to be informative. If you've got ideas, please let us know. If you have people that who you think would benefit, please share this video. Please like this video. Help us with the YouTube algorithms. Write in the comments if you have any questions or you have something that you'd like to see. And I'm going to look forward to seeing everyone on the next video.